So, like, no doubt everybody's impressed or scared by the monthly drop you had the tail end of last month, which so far basically ceased then, by the way. But a horrible looking candle, big reversal. It looks terrible. Okay. When you go to a momentum chart and you look at, let's say, annual momentum or quarterly momentum, where you're plotting these monthly bars against these long-term averages, and you're looking for structure, like, is there a major uptrend line that I'm breaking, or is there a floor? No. In neither case does that break even approach any structure that you could consider valid. The momentum trend, first of all, the price trend was obviously up as well, okay? And we were challenging and finally nipped out those $50, what I call idiot highs, because they lasted for a half a century, $50, $4, et cetera, back and forth, confined like no other market on the planet almost. Gold wasn't confined during 50 years, neither was copper. Okay. Anyway, so at the time of that conference, $48, what are we now? We're trading right now as we speak, 76. So, terrible. Okay. Percent-wise, it's a huge gain. Yes, we're well off the high we just saw last month. But at that time, a couple things had already happened. One, we look at the trend of silver and gold in long-term momentum metrics. Like, for example, we measure the monthly price action of silver gold in relation to, let's say, a 3-year average or a three-quarter average. These are fairly long-term yardsticks. And we don't just overlay the average. That's not meaningful. Sometimes you can cross those averages and who cares? Okay. It's when you plot the bars of price in their relationship to a given moving average. Like, is it above it or below it? Okay, and if so, what's the high of the month, low of the month, close of the month in relation to that given moving average? And those averages change, of course, every month on a 36-month, every quarter on a three-quarter average. But anyway, you get a different chart when you plot momentum in bar chart form against certain long-term averages. And you see trend structures. The kind of things that an average price chart guy would, like, he'd draw a line across a couple highs and say, oh, we broke out over that line. Or a floor that you've used 2-3 times and you break below it, therefore it's all over, it's going down, that kind of thing. We do it with momentum. Almost always when there's a trend shift, even short term, intermediate or long term, momentum usually will break its structure and indicate the new direction prior to price smacking you in the face and saying, oops, I'm going down or I'm going up. Okay. So it's a good leading indicator, and you can anticipate trend changes, especially when you see on momentum a structure that just is so clear and used so many times as resistance or as support. And usually they don't last forever. I mean, you can only use a certain level so many times, and finally, if you hit it too many times, you go through. Okay. That's true with momentum. Anyway, at that point in time, silver on our long-term momentum metrics was already fully positive. In fact, one of our primary entry points was before that, was back in, if you recall, silver was capped in a range with a high above 35 in late 24 and a high above 35 again in March of 25. Confined there was like a year there where it twisted and turned at that level and to the downside, a congestion zone, but very wide. The third time that it came back up toward that 34, 35 level was back in June of last year. Silver still in the mid-30s, still in that range, but momentum said, you're breaking out. Price had not yet broken out. That would have required getting up to 35.50 to blow out those two prior highs on the price chart. But as it approached 35, that third time, our momentum broke out and we said, okay, acceleration phase for silver now commencing. Meaning, rather than this 2 steps forward, 1 step back process, it's going to be like 5 steps forward, 1 step back. Okay. And boom. Later in the year, we're at the $50 level plus. Okay. Challenging the old idiot highs. But then something else happened. And that was in November, a month after our conference in Toronto. At that point in time, Nothing had changed on the silver price or long-term momentum positives. They were positive already, no big deal. But why is it all of a sudden, after the November close, which I think was in the 70s or something like that, silver broke out versus gold, where when you plot the spread chart relationship between an ounce of silver into an ounce of gold, you go back 50 years, you can do that. You'll find that back in the 1980 bull surge in silver was 6.5%. Divide an ounce of silver and an ounce of gold of the price of gold. Okay, keep that in mind. And then it dropped back down. And then in that same 50-year price range, in the second surge in that range, which peaked in 2011 at $50, silver versus gold reached up to 3.1%. Okay. Early last year, silver was at 1% of the price of gold. I mean, you think it's going to free? Okay. Mm-hmm. Anyway, so during the year last year, as we turned up, but especially after that at that November close, when we plotted that chart, you blew through a ceiling on that spread chart, where if you plot each month's close, there was a clear multi-point ceiling that kept stopping all the rallies in silver versus gold. We closed above it in November. And it was at that point we said, okay, the lid is really coming off now, because silver, whenever it does this versus gold, which it did in 79 prior to the explosion in 1980, and it did in late 2010 prior to its explosion again to 50, that spread broke out. And when that broke out, it told you the temper and tone is changing. So what happened since then? Well, we went up to $120. In 2 months, we went up to 120. Normally, when you see these spread breakouts of silver versus gold, like in that 79 period, in the summer of 79 or September 2010, it's over the next couple quarters that you see the consequence, not over 2 months. It's a massive chart breakout spanning a year or more of resistance, where silver just couldn't get up above this level. When you gush through that, you gush. And you usually gush for a couple quarters. And yes, in the middle of each of those surges, there is a shin kick that, oh gosh, it's all over. This one came a little sooner than we expected. We were frankly expecting a midpoint stumble late this month or early March. Instead of being like in the third month of the 6 month or so surge, it occurred at the end of the second month, earlier than we expected. So we were wrong in that regard. And it was deeper than we expected. But frankly, when we look at the depth of that sell-off, which got down to 71, 72, on Monday, first day of this month. So we had like a day and a half collapse, really. It was all a day and a half, the whole drop, a day and a half. We dropped back to the rising 3-month average on silver, a level it has not seen since the first half of last year. So to return to a rising average that is now acted like support. Sometimes you have to return to the mean, 3-month average isn't super long term, but it returned there, and it tested it again today. So anyway, we view the pullback as being a very sharp but non-event in terms of changing our outlook. We still think silver is in a rampage. This is what you would call the midpoint stumble. And what we expect this month to see is silver firm again in February. Probably not see a new high this month. In other words, the January high stands, okay? True for gold and silver. But we see a firming action such that by the end of the month, we're well back up off this low and somewhat approaching the January high. It's in March that I would expect that if after we see that stability action this month, that you then resume. And March says, okay, game on again. And then, again, if we're correct in our analysis, and we have multiple reasons for coming up with this observation of the 6-month surge, it's not just that one thing, you could see silver reach into the several $100s. zone, like 3 to 500. And that sounds ludicrous, I know. If you want the explanation as to why that's sort of a target, I can give it to you.
Traditional price charts often react after the fact. Momentum analysis, when structured correctly, tends to move first. Instead of focusing on simple crossovers or popular oscillators, long-term momentum is best understood by measuring how monthly price bars behave relative to evolving averages, such as 3-month, quarterly, or multi-year benchmarks. When momentum repeatedly respects or breaks these levels, it forms recognizable structures, much like trend lines on price charts. The key insight is timing. Momentum structures often fail or break before price confirms the move. That makes momentum a leading indicator, one that can warn of acceleration or reversal well in advance.
And it's these external factors, and also we got to watch T-bonds going forward too, but there's external factors. You don't just look at a silver and gold chart. That's a mistake. You got to look at these major external factors, because what they're saying often will alter something you might be thinking about silver, like getting negative because of the recent drop. And you got to look at certain other things. But as for Bitcoin, okay, it peaked at 128,000, okay, a couple months ago, back in October, November, okay. As it was making that high, and everybody was talking $1 million Bitcoin, whatever, momentum of Bitcoin, long-term momentum of Bitcoin did not look at all like what the Bitcoin price chart looked like. Instead, the momentum chart looked like a lamer and lamer advances, with each price advance getting to new highs. The momentum readings kept making lower highs, which they were getting more anemic. And they built a floor since 2023. They'd used it 3 times at the 3-quarter moving average. They don't always build a structure at an average, but in this case they did. The 3-quarter moving average of Bitcoin, you didn't close below it 3 times. You traded down to it 3 separate pullbacks during that price advance. We could tell you were going to break it this time. Sure enough, we broke it a couple months ago. Our trigger levels were 107, 104 area. Okay.
And as soon as it broke 107, it fell apart, just as you said.
It dropped down, into the low 80s. Okay.
Right.
And we argued, though, that pause that we saw, a couple-month pause, with a rally up into the upper 90s. Okay, so a lot of people felt like, oh boy, it's good. We said you're going to have a congestive pause. Don't get deceived by it. Probably your minimum going to 60,000. Well, the last few days we got down to like 66,000 today as we're speaking. Okay, so we're getting there. And I'm not saying that's going to be a bottom or a buy point. I'm saying that's like a minimum downside target. You may go to 20,000 for all I know. You've blown long-term momentum structure on Bitcoin, and you did it only a few months ago. So it's not like a breakout that's gone for a full year and exhausted. It's fresh. Mm-hmm. So this is a broken asset. Okay. And I know a lot of people are hurting right now, not just financially, but conceptually. I didn't think this would happen. What's reality now? Okay, that's one issue. And that have impact, I think, probably on some financial connections, some corporations that are now involved in Bitcoin that 5 years ago had no relationship to what happened there. Now they have a financial, it's a shin kick or a gut kick for them. What's going on?
You're talking about the companies that bought Bitcoin in their treasuries, correct?
Yeah, and even Visa allowed Bitcoin to some extent be used in payments and so forth. And
okay.
It got entrenched in a lot of places that now could be feeling the gut kick. Okay, so it's bigger than just Bitcoin.
And then Bloomberg commodity.
Bloomberg, yeah. The Bloomberg Commodity Index made its high at 140 price level. After making a bear low under 60 in 2020, it rallied into early 2022 to 140, so more than a doubling. But even then, it was like half the price of what it had been in 2008. Mm-hmm. Okay, so yeah, a nice big rally, but it was still underpriced versus its own history. Then it pulled back under 100 and labored on either side of 100 on the Bloomberg Commodity Index, about a 50% pullback of that bull surge, okay, for several years, 23, 24, 25. In October of last year, it broke out on momentum above our trigger level, which was 106.50. It's since, right now, it's trading around 117, 118. Okay, so it's gone up, not exploded, no headlines. It's just worked its way higher. Few people are noticing. In components within the Bloomberg are very important because they impact the average guy on the street. Trump says he's going to keep gasoline down, right? Okay. We broke out via our long-term metrics on crude oil last month. I suspect that the consequence of that, the initial consequence of that, over a couple quarters maybe, or maybe even one quarter, will be to get back up into the 90s. You said, well, that's a 50% move, big deal. Actually, it's not. You were 130 in 2022. Before that, you'd been 140 oil. So getting back into the 90s is no great chart achievement, but it's a 50% boost in gasoline prices, which is going to hit a lot of people in the face. And also wheat broke out over a massive momentum ceiling that we had defined. So it's now engaged. So you got a problem here. You've got a major low-priced asset category, historically low in its own price levels, prior price levels, and low in relation to the S&P and low in relation to almost anything. It's cheap. And it's saying, I'm going up now. It's joining gold. Now, why would you have the commodity complex freshly join on the coattails of the monetary metals and think that the monetary metals have just topped when commodities are just now joining in? Think about that, okay? It doesn't make sense. Okay, anyway, I think the Bloomberg is now a very positive place to be, or commodities and commodity-related stocks, oil stocks, grain-related, fertilizer, base metal miners, things like that, are a safe and beneficial place to be probably for several years compared to the stock market. Anyway, so another big category.
Before silver visibly cleared its price resistance in the mid-$30, momentum had already broken out. After multiple failed attempts near the same level over more than a year, momentum finally pushed through, signaling an acceleration phase. That shift meant the market was no longer moving in cautious steps, but entering a phase where gains could come faster and pullbacks would be shallower. Months later, price followed, rapidly challenging the historic $50 level. This pattern, momentum first, price second, is consistent with past major silver advances, including previous secular bull runs.
The notion of momentum analysis today, the popular one, is to look at some wet noodle indicators. And literally, they look like wet noodles. They do this, RSI, MACD, things like that are free on your quote screen. Okay, they indicate, well, I'm overbought, I'm oversold,
and they bounce around like crazy.
Yeah, they don't have structures. They just sort of loop. They're wet noodles. Okay, and sometimes they have validity. There's no question. I'm not going to doubt them. But then other times they just don't, okay? Like you can get a market, like silver's been overbought. Back in the 79 to 80 move, for example, you would have missed the entire move had you looked at RSI, monthly RSI. It got overbought and stayed there for a year above 80 on RSI. You would have missed the entire bull move if you'd gotten out first time to get overbought. Okay, structure. Again, we plot bars, monthly high, low, close, but in relationship to what percent above, what percent below, or how many points above, how many points below a given moving average. And when you plot it as an oscillator in relation to that mean, might be a 3-year average, or 3-quarter average, a 3-month average. You plot it versus these various means, and you'll get a chart that looks different from the price chart. Same high-low monthly bars, but instead of just based on where it is in relation to the US dollar, which itself is not a fixed yardstick anyway, it's a piece of rubber, okay? But when you plot it versus its own moving averages, long term down to intermediate term, even short term, you'll get an oscillator that it's a bar chart oscillator, but it doesn't always reflect what the price chart shows. The price may say, look, I just made a new high. And you look at momentum and it says, I'm making a new high. That's a hint sometimes. But what we look for is structure, and by structure, it's simple. It's what the price guys look at. They draw uptrends, they draw flat lines, where the price keeps hitting this line or it keeps hitting the same floor, and they got a structure. We do the same thing with momentum, but momentum will often develop the structure when price hasn't. And momentum will say, gosh, I just blew through a triple bottom. And price doesn't even show that. It shows rising lows, let's say. But momentum said, I just blew a major structure. That will usually happen before price chart smacks you in the face and says, oops, I broke something. Okay, so that's what we mean by structure. So I'm no doubt everybody's impressed or scared by the monthly drop you had the tail end of last month, which so far basically ceased then, by the way. But a horrible looking candle, big reversal, it looks terrible. Okay. Mm-hmm. When you go to a momentum chart and you look at, let's say, annual momentum or quarterly momentum, where you're plotting these monthly bars against these long-term averages, and you're looking for structure, like, is there a major uptrend line that I'm breaking, or is there a floor? No. In neither case does that break even approach any structure that you could consider valid as something, oops, I don't want to break it. Okay. There's not even any structure nearby. And in fact, in the case of annual momentum of gold and silver, they haven't even developed structure to break. What does that mean? What it means is usually before you top gold or bottom gold, like in 2011 or 2015, you could see annual momentum structure develop an 8-point uptrend line that you broke 2 months after the high in 2011. You didn't break it on the price chart, but on momentum, you could go back like 3 years and there was an uptrend that was hit 8 times. So, and you look at the price chart, you can't find that trend line. Mm-hmm. And similarly, at the low in 2015, gold, once it collapsed in 13 and 14, it then kept going down into 2015, reaching $1,050. But it kept making lower highs, sort of staircasing, but a little more gently. Okay, so still down. Momentum, on the other hand, for 2 years, had built a horizontal sideways range with the same highs being hit 3 times. Mm-hmm. So you had a ceiling you could see, wasn't evident on the price chart. And in February of 2016, $90 off the low at a price of $1,140 after the $1,050 low, you blew through a multi-year ceiling. It said bull market on again, based on annual momentum. Since then, nothing has broken on annual momentum that indicates trend breakage. You've had zigzags, but you've not had anything that broke a structure that you could say, oh, it's over. And right now, you're not even near anything. You'll develop the structure before you top gold.
One of the most powerful confirmations came from silver's performance relative to gold. Historically, explosive silver bull markets begin when silver starts outperforming gold decisively. In late 2024, the silver to gold spread broke above a multi-year ceiling that had capped every prior rally for over a decade. Similar breakouts occurred before the 1980 and 2011 silver surges. What followed was unusually fast. Silver surged dramatically in just weeks rather than quarters. The recent pullback, while sharp, does not negate a breakout of this magnitude. 10-year structures don't fail after 2 months. They evolve.
You've got a moving average. In our case, we use averages. A lot of people don't, like a 3/4 average. A lot of people use 200 days, which is about the same duration. We use a 3-year average and sometimes a 36-month average, which is a monthly change in a 3-year average, okay? 3-year average only adjusts once a year, for example. Boom, your new average, okay? Applies all year. And you plot the bars, whether they're above it or below it. So it's pretty simple, really. Okay. You come up with your average, and then you plot this month's bar in its proximity above or below that average. Sometimes we'll plot it on an arithmetic scale, like how many dollars above or below. And sometimes we'll do a percent scale, how much percent above or below. But it's not really difficult. It's just, and then we also use different averages. So we want to see, for example, if you break a trend on an intermediate type metric, let's say a 3-month average, which is sort of intermediate. In other words, when you break it, it may only be worth a 5-month move or 6-month move, not a multi-year move. So we like to look at that and know, well, what's the context here? If we just broke something that's short-term or intermediate, does it really alter the longer-term trend? And if it does, then, oh, that's important. But if it doesn't, if it's just a correction within a long-term trend, we note that. And we might tell our subscribers, yeah, you just broke something but it's intermediate or short term. So if you're concerned about what happens in the next 3 weeks, then, be concerned. But if you don't, then don't. Okay. Because the big picture still says it's okay. So it's the time scales also matter. What's your context? But it's simple to do. Yeah.
The last term is spreads. Yeah. Do we need to talk about that or not?
Well, a lot of people do the ratio of silver to gold.
Okay.
The multiples. We just do it a different way. We divide an ounce of silver and an ounce of gold and express it as a percent. It's the same study, except it's upside down version of a ratio chart. Okay. But you plot that. And like, for instance, we'll plot, where do close each month? Silver price into an ounce of gold. And you plot it on a chart, it's X percent. And then you plot the next month and and after a while you get a spread chart building structures maybe, or trend lines. In the case of silver recently, it had like a 10-year wide structure where it couldn't get above this shallow level versus gold. And the close of November it did. Okay. A fresh breakout over a 10-year wide structure does not end 2 months later. Okay. That's the message. You don't break out over a 10-year wide base and expect to see the top in 2 months. Mm-hmm. A pullback, yeah, but it just began, in other words. So you look at the context as well. Now, if that structure were only something that went back 3 months, then maybe, yeah. But you had a 10-year wide structure. So when you look at that, you realize this is big. This just changed. And you mentioned another issue, gold in relation to the S&P. That also broke out. Silver versus the S&P. Gold and silver miners versus the S&P. All had spread relationships to the S&P where you could plot a line going back to 2014. So 11-year wide, either slightly declining or flat. And they all broke through that relative performance structure in November, saying, hey, I'm now a better place to be than you are. And it just began. You don't have something that big and wide that breaks out over something that smacks you in the face and expect the high in 2 months. Okay, that's another message for the longs right now. Mm-hmm. But yeah, it's simple. A spread is just a simple chart expressing the value of one to another. And it develops technicals, just like price chart guys like to look at, trend lines, ceilings, etc.
Silver is not moving in isolation. The broader commodity complex has begun to turn higher after years of underperformance. The Bloomberg Commodity Index recently broke out on long-term momentum, while crude oil, grains, and industrial inputs are following. This matters because commodities typically don't join precious metals at market tops. They join during sustained inflationary or reflationary phases. Rising energy and food prices also carry real-world consequences, reinforcing the macro backdrop that supports hard assets. When monetary metals and cyclical commodities align, it suggests a longer-lasting shift in capital flows rather than a speculative spike.
If you drop down to a more intermediate timescale, because again, I said quarterly and annual momentum, there's not any structure that's anywhere nearby to say, oh gosh, I broke it, it's over. Okay. It just doesn't exist.
That's the long term.
Okay. That's long term. Drop down to intermediate, and intermediate would be monthly. Month to month versus a 3-month moving average. Okay. Usually when you get trend swings on that metric, on the oscillators, you'll see they run for 4 to 6 months. Okay. That is if you break a structure. Now, this recent pullback, instead of breaking anything, it came down to an average, the 3-month average on gold and silver, that it hadn't seen for silver, for example, since before last summer. So all these months of rising silver, you never even condescended to pull back and touch your rapidly rising 3-month moving average, like the zero line on the oscillator. You hadn't even come down to it. So finally, we touched it early this month, the first day of this month, when we had a slight further follow through to the collapse last month. You touched the 3-month average almost precisely, and you rallied $20 off of it. Now you came back and retested today. It's not structurally important. It's just an interesting fact that you haven't even returned to a balance point, a zero line, the 3-month average. And it's likely we'll find support there. Gold did the same thing. Gold broke it by, I think, about $50 and immediately exploded. So that's what I think we just saw. And it was merely a return, even on intermediate stuff, that said, hey, this might be a place to buy. Now, when we shrink down to weekly and go to like a 3-week average, we blew a structure on weekly on Friday a week ago. And sure enough, instead of a nice sell-off, you had a huge sell-off. We've broken that same structure before on weeklies and only had a, so-so sell-off. This time it happened to be big. This week's high rallied back up to the 3-week average, which changed from last week, obviously, and bumped our head on it. So on the oscillator, you broke through the 0 line, and this week you came back up and bumped it. So what had been prior lows, now, boom, you bumped it. You set that level. So next week, with a now falling 3-week average, if you get back above it, the weekly momentum, which had a stumble and broke a minor structure, you'll reassert yourself back above the structure saying, okay, game over, I'm back up again. And all it takes is getting back up into the upper 80s anytime next week on silver. We'll do that. So, but again, that's short term. So don't confuse it with an investment grade position.
Recent volatility has rattled investors, but context matters. On long-term momentum metrics, annual and quarterly, neither gold nor silver has broken any meaningful structure. The recent drop merely returned prices to rising intermediate averages, a normal feature of strong trends. By contrast, assets like Bitcoin broke long-term momentum structures months ago, signaling deeper risk. The lesson is scale. Short-term breaks affect traders, not long-term investors. Until major momentum structures fail, the primary trend remains intact. In markets, real tops build slowly, and this one hasn't even built the foundation yet.